I'm Matthew Owens. I'm a California licensed CPA and a full-time real estate investor. I've purchased a little over 175 properties in the last 5 years out in the Memphis, Tennessee market. I live in Redondo Beach and want to deal with the sunny weather out here and not living in humidity and rain out in Memphis. But I also help my investors with looking at their own individual financial plans, their own cash flow structures, and their individual goals, and trying to help them achieve those goals, and look at the tax structures, the legal structures, and really try to help investors to get the right structure for them. Make sure they're in the right path for real estate investing. And I help a lot of investors. I raise a lot of capital. I also go through and have done syndications in the past and things like that. So that being said, I'm going to go ahead and introduce you guys to the speakers, Kyle and Kenny right here. They've actually developed an application. They've developed a lot of apps, but one of the most important ones is a financial calculator for an application on for your phone. I use it every day. I know there's a lot of note investors that use it on a consistent basis. I think it's one of the most valuable apps. It's like $6, right? Compared to what does the normal calculator cost? Like 40, you know? So, and you got it on your phone with you at all times. You don't have to carry a calculator with you, you know? So for the other CPAs and math people in the room, you know, we always carry calculators all the time, you know? So, but anyways, I'm going to go ahead and have you guys come up and go ahead and start with your introductions of who you are and what your backgrounds are, and we'll take it from there.
So we are in-a-day development. I'm Kenny Wyland. That's Kyle Humfeld. And, you know, we really appreciate you guys coming out tonight. We hope we will make it worth it. We've distributed some feedback forms. They should be at everybody's seat. You know, we want to improve this presentation, and so your comments and suggestions will be very valuable to us. So please, if you could fill one of those out and leave it on the back table before you go, that'd be fantastic. Okay, how about this? Is that better? Okay, great. So just a couple of quick questions so we can gauge. How many people know what a financial calculator is? Great. Okay, and who has one? Not with you, but just has one. Better. All right, and who wishes they knew how to use it better than they do now? Fantastic. All right, so a little background on us. We're a couple of computer nerds. We're also cash flow investors. But as computer nerds, we're fans of making computers do the work for us. Okay, we do the thinking and they do the working. So when we were introduced to the idea of passive income through rental real estate, through income through notes, et cetera, we knew that that was the game that we wanted to be playing. We could use our skills and our knowledge to create a portfolio that would be self-sustaining and it would do the work for us, so that we could live in the fashion that we prefer, which is generally in front of a computer.
So we met at USC in the late 1990s, fight on for all you Trojans out there. And we've been friends ever since then. Before I graduated, I started working for Boeing as an intern, and I've been working there ever since. I'm about to celebrate my 15th year with them. One of the benefits that having a long-term W-2 job like that has provided has been the ability to have a steady income, actually get bank loans, and have sort of that steady income that the banks like to see. We've been actively investing for about 4 years now, and my wife Tiffany, the short redhead in the back, whom everyone in this room probably knows, is our full-time real estate person. She's managed to pick up about 4 properties, done one master lease, and bought a couple of notes. So we're not quite ready for me to say goodbye to Boeing yet, but we're moving in that direction.
So after I met Kyle and graduated, I jumped headfirst into the dotcom explosion. And it was as cliche as you've all heard, you know, with the crazy hours and trying to get funding and ridiculous expenditures on office furniture. You know, everybody had 2 Aeron chairs. Now the crash happened, but I was able to make it through pretty well, and I was fortunate enough to end up working for Google, which was nice. I didn't walk away crazy or anything, but it afforded me enough freedom to strike out on my own. when I did, Kyle introduced me to the concept of passive income and rental real estate, and the idea it took hold of my brain like a virus, and I was instantly hooked, and I was in. It was going to happen.
At some point in every software engineer's life, there comes a point when you get tired of writing code for some big faceless bureaucracy. You know, you save the company a couple $100 million and they don't even give you a raise or a luncheon or anything. I mean, come on, people. So if we can make that kind of an impact for them who don't care about us, imagine what we can do for ourselves. So one of those moments happened to me about 2.5 years ago. And we decided to start our own software company and make iPhone apps. This was before the iPad came out. So as nerds do, we bought a book and we sat down and went through it together. And as nerds do, we absorbed the new information and put it to work doing our bidding. And so we put together our first app, and it took us just 1 day. And thus, in a day, development was born. Now, it was a stupid app. Yeah. The app is completely stupid, and there's really no reason that anyone should ever buy it, but they do, almost every day. And we have we're not complaining. We just are continually amazed at the internet's appetite for stupid things, which it completely is. So fast forward a couple of years, and we've got more than 24 apps for iPhone, iPad, Android, and Mac desktop. And the income isn't totally passive, but it throws off money like a small apartment building. So that's pretty cool. And over the past year, we've done some contract work for big names like Nike and BlackBerry. And we're about to sign another gig, hopefully with Nike. And so that's allowed us to build up enough capital to purchase mortgage notes or property, things that will basically provide that passive income that we personally and corporately want. And hopefully the first of those note purchases is going to be complete within a few weeks.
All right, so our flagship app is a financial calculator, like Matt was talking about. And to create a financial calculator app, we had to really understand the math behind finances. And to make the calculator useful to everyone in this room, like to all investors, we also had to really understand how it's used in the real world. So given all of our background, we're not actually here to talk to you about our calculator. Okay, we're just, we do have some pictures in our slides which come from our calculator, but that's just because it's easy to do. We just want to talk to you about financial calculators in general, why they're important, why you should have one, why you should know how to use it. Okay, and that is the time value of money, because the calculator will make dealing with the time value of money very easy for you. It will make your investing more effective. It's something that every investor should understand.
Okay, so that's what we will be doing. What we won't be doing is frying your brain with tons of numbers and buttons and stuff on your calculator. Now, it's important to know how to do all of that stuff eventually. But tonight, we're going to be discussing the general concepts, how they work, why they're important, and how to put them into action in your investing. So I understand well that math can cause people's brains to shut down, so we'll be avoiding math as much as possible, actual math. Now, obviously, we can't avoid it completely, but we'll do our best to make it all understandable. The important thing is to understand the concepts, not necessarily to be able to multiply numbers in your head or doing anything fancy. Therefore, we have one primary rule for this talk, and that is don't freak out. So we're here to share knowledge that has been shared with us. And so if any time you have a question, or if I talk too fast, because I always talk too fast, go ahead and raise your hand or shout it out or whatever, and we'll do our best to answer your question, or I'll try to put the brakes on. Good?
Okay, and before we jump into the not math, we have a debt of gratitude that we want to acknowledge. Okay, we would not be here without the people who have helped us. All right, Gary Johnston and Clyde Wilson are amazing. They run a couple of classes. Matt was talking about them earlier. Financial freedom principles, money not math. They're incredible. Everybody must take them. They also taught a class called The Next Step that they did with Henry Dvorkin and Bobby Redwine. Henry Dvorkin, he has an audio program called 23 Ways to Buy a Mortgage Note. And it's got the craziest, most amazing ways to structure note deals in it that you've ever seen. It will twist your brain. but you have to absolutely check it out. Now, we got some sad news this week. Henry actually passed away Monday morning, so we're very sorry to see him go. He was a great investor, a fantastic educator, and just a really nice guy.
So Bill Tan, San Diego guy, he runs a couple of investing clubs in Southern California. He teaches a series of classes on how to use a financial calculator specifically. So if you're a newbie and you need to get your feet wet, he has some classes you can take. Jimmy Napier wrote a book called Invest in Debt. It's an excellent primer on note investing and the time value of money and how to use a financial calculator. We haven't had the pleasure of attending any of his classes, but several of the other people on this list have done so, and they say that they're excellent. Peter Fortunato, who's coming to town in a couple of weeks, as Reggie mentioned, he will completely melt your brain and change your whole concept of what's possible with creative financing. He lives in Florida, so anytime he comes to Southern California, you owe it to yourself to check him out. Sure. I've seen him a couple of times, and if I can make time, then I will see him this time. And I'd recommend everybody else does too. Ellis San Jose and Gerald Lemoyne, Gerald's sitting right here. They've helped us understand a lot about investing in notes and creative financing. And of course, Ellis is one of the founding members of FIBI. We've got Matt Owens, who's given us fantastic advice on how to structure our company and how to grow our assets. He's also helped many of us, probably many in this room, including me personally, to acquire cash flowing properties in Memphis. And we're looking forward to partnering with him on a deal in the future.
All right, so this isn't the whole list of people we've learned from. We could go on all night. There's a lot of great teachers, but these are some of the teachers who've really helped us with topics related specifically to this presentation. So we want to thank them from the bottom of our hearts. We wouldn't be where we are today without them. All right. Okay, so what is the time value of money, right? What does it really mean? We all have an inherent understanding that time has an effect on money, right? You know, would you rather have $100 today or $100 10 years from now, right? Everybody would rather have that money now. We all understand that it has an effect, that time is valuable, but how valuable is it, all right? That's the entire point of studying the time value of money. For example, when you're dealing with a mortgage, you're going to get a bunch of money today and you have to pay it back over time at a certain interest rate. When the bank is figuring out your mortgage payment, they're using the time value of money, right? When your credit card statement shows that it's going to take you this long to pay it off with the minimum payment, they're using the time value of money. When your broker tells you that your 401k is going to be worth off in the future, he's using the time value of money. Okay. Now, behind the scenes, there's some very, very complex math used to calculate, how valuable that $100 is 10 years from now. But you don't need to know how to do all that math. That's the good part.
So that question of how do you do financial math is why financial calculators were invented. So a financial calculator is like a normal calculator that everyone's used to. It has all of your numbers and it has your plus, minus, multiply, divide, but it has some extra buttons on it that know how to do all of the complex financial math. So you just tap in a few numbers that describe your situation and it'll figure out the answer for you. One of the things that you can do with a financial calculator is figure out what kind of a yield you're getting on your money. We'll talk about how to do that on your calculator a little later on. But for now, we're going to talk about a simpler method that can get us a good approximation. So we'll work our way back up to the calculator, but we're going to start with the basics.
All right, so when we invest our money, most important thing we want to know is how good the investment is, right? One of the factors that we use to qualify an investment is its ROI, or return on investment, right? You've heard this term before. It's the simplest method to determine how good it is, and the way you calculate it is right in the name. Okay, you take the return and you put it on the investment. Okay, your return, the amount of money you're going to get back, is divided by your investment. For example, like if you were getting $2,000 a month, that means each year you're getting $24,000, and if your initial investment was $125K, you're getting a 19% return. You just take 24,000 divided by 125,000, and that's it. Now, sometimes when we run into people and they're trying to do a quick ROI calculation, one of the things that we'll commonly misdo is that they'll put the investment on top. So just remember, it's return on investment, okay? So you can always get the right one. All right, so if you've ever played cash flow, as we know some people have, this is the way that they calculate the ROI in the game on the cards, okay? So, you know, this card, your cash flow is $500 a month, right? Your down pay is $20,000. So 500 times 12 months, it's $6,000 a year. So that's the return. That's how much this investment is returning to you. You put it on your investment, $20,000, and you just do division. So it's a 30% ROI, and that's what the card says. So when you're playing, that's how you know that that's what they're doing.
So one problem with ROI is that it's actually only a piece of the puzzle. So knowing that an investment gives you a 10% return doesn't actually tell you that much about it. So for example, if you have an investment that pays you $1 a month, so $12 a year, and you only paid $120 into it, that gives you a 10% ROI. On the other hand, if you have a different investment that gives you $1 million a month, so $12 million a year, and you had $120 million into it, that also gives you a 10% ROI. So obviously ROI is not the entire story. Makes you wonder, why do we use it? Well, ROI can be very useful as one factor in comparing different deals, different investments, even though it's not the whole story. So it allows you to take two very different situations and compare them in an apples-to-apples fashion. So for example, we're trying to compare investment A and investment B, and we see that investment A, we have $240,000 invested, and it pays us $58.50 a month. Investment B, we have $137,000 into, and it gives us $12,700 a quarter. Which one's better? I don't know, but math does. So all you do is you find out how much each of these pays you per year, and you divide it by the amount that you have into the deal. And in doing that, we find out that investment A gives us about a 29% ROI, and investment B gives us about 37%. So absent any other information, investment B seems better. But like we said, that's just one piece of the story. So we shouldn't get too fixated on just that.
Okay, and there are only two ways of increasing your ROI. One is to get more money, and one is to put less money in. Okay, you can do them both at the same time, but those are the two ways. You either have to increase your return or decrease your investment. So, you know, we were just talking about that 19% return, right? We're going to get $24,000 a year. We put in $125,000. Now, one of the most common ways of reducing your investment is leverage, right? So we're actually going to just put $25,000 down on this house and finance the rest of the 100. So $24,000, which is how much we're going to be getting, over 25, which is now our lower investment, that's a 96% ROI. That's pretty good. Now, obviously, that's not how it really works, because out of that money we get, we're going to have to pay debt service, right? But so we reduce the amount on the return, but it's still higher. Okay, we're still going to be getting back more money. Now, 70% is a pretty awesome return. We're just making some numbers up here to show the point. But that's the idea. Is those are the two ways of increasing it.
So we've just seen an example that uses leverage, and leverage isn't necessarily or inherently a good thing or a bad thing. It's just really a magnifier. So if you have an investment that's fundamentally good, leverage can make it much better. But if you have a fundamentally weak investment, leverage can make it much worse. So while leverage can crank your ROI through the roof and it can accelerate your growth, if you happen to make a bad mistake with leverage, then it can threaten all of your other investments up to and including your entire net worth. Was that not loud enough?
All right. So who wants this deal? This was a question that Gary and Clyde asked at one of their classes, right? It's a $55,000 purchase price, $10,000 down payment. The landlord assures you that you're going to get $315 a month in net rent. Okay, so this is over a 37% ROI. Anybody? Who's in? I got 1, 2, 3. Okay. All right. So this is the house. All right. Now who's in? I'm telling you, he assures you it's going to get $315 net rent. Okay. Well, Now, let's say you can buy this for $55,000, but what happens if the land is worth $90,000? Maybe the guy who's selling it, he just really needs to get rid of it. All right, now who's in? Okay, long story though. It's got $50,000 in back taxes. All right, so I mean, like the point that we're trying to make here is that ROI is useful, but don't get hung up.
Yeah, no problem. So essentially, the more information you can know about your deals, the better. So as we learned as children, knowing is half the battle. Okay, so the numbers are a tool that are to be used by the smart investor. But you can't be controlled by the numbers. You have to look at the whole situation. If you get hung up on the idea that you need an 18% return, then you probably aren't going to be successful because you're going to pass up on a lot of good opportunities and waste a lot of time that your money could have been used to make more money. We play the cash flow board game fairly often, and we find out interesting things about ourselves when we do. One behavior we've observed in playing over and over again is passing up on good deals because they're not quite what we want. So, we've got it in our head that we've got to get a 60% ROI. So we get a deal, it's only 48% ROI. Oh, it's only 50% ROI. And so we pass up on these deals. But then what happens if the 60% deal does come up, but he's the one who pulled it and not me? Or I don't have the money to actually exercise on it. Basically, we've found that we end up spinning our wheels a lot and not actually getting ahead if we get too fixated on that number. So time is the important aspect. So don't waste time.
This is one of my favorite quotes from Gary, right? Your money's job is to make money. But your job is that as soon as that money comes in the door, you got to turn it right back around and get it out there making more money. Okay, so this is the idea that time is important, right? Because if it's not doing anything, you're wasting that time, and that time is essential to making your money grow.
So let's say you've got a good ROI. You invested $10,000 in a startup company, and they say they're going to pay you back $2,000 per year. Doing the simple division, that's a 20% ROI. That's pretty good, 20%. But what happens if you've invested in them and they pay you $2,000 your first year, and then they go bankrupt? Well, you're not getting any more $2,000 payments. So at that point, you didn't even see your initial principal investment back, which means your real ROI is negative. So you didn't get your 20%, you got negative. This is, of course, one of the other reasons we like real estate, because when we lend out money, we can secure it to something that hopefully has some actual value. So if something bad happens, then we have some way to recover from that. It mitigates our risks a bit. Now, typically, we've been focusing on return on investment, but we as investors need to remember about return of investment. Make sure you get your seed capital back, and then after that, you can enjoy all of the interest and all of the profit that it pulls in. So we've seen that the stated ROI is really just a conceptual number rather than a real concrete number. The simple calculation of return on investment assumes that you'll be getting that payment every year forever. So let's take a look at this concept a bit deeper, and we'll see how time changes the real concrete number rather than the conceptual.
All right, so we'll go back to this startup, right? We invested $10,000, and they're going to pay us $2,000 every year, right? Now, if they pay us, they stay in business and they manage to pay us for 5 years, that means that we get all of our principal back, right? 2,000 times 5, 10,000. So our real ROI was 0%. So remember that this is how time is affecting these. Now, if we were able to get payments for 10 years, the real ROI is 15%. Now, trust us on the numbers here just for now. The math on how this works is a little more complicated, but we assure you these are correct. Now, if you were able to receive the payments for 15 years, you'd get 18.4. If you kept going 20 years, you get 19.4. It gets closer and closer and closer, but you're only going to really get 20% if you get those payments forever. So just remember that your simple ROI calculation is just a conceptual number, and you have to, and time is an important aspect of it. It's just a useful tool for estimating what your return on investment is going to be.
Another tool for estimating various things in investing is called the Rule of 72. You may have heard of it. It involves estimating how long it will take to double your money based upon your ROI. Kenny and I don't consider it to be particularly useful because our goal is not to get that double-sized pile of cash. So we're looking for cash flow, so we're never really seeing that big pile of money. As soon as our money comes in, we try to turn it back around and get it right back out there working. So, you know, we go to a lot of investor conferences, a lot of classes, and a lot of times in the pre-event soundtrack, we hear the song Billionaire by Travis McCoy. And it starts off with the line, "I want to be a billionaire." But I think he's got the mindset all wrong. You see, he wants to be a billionaire so he can buy all the stuff he's always wanted to buy and do all the things he's always wanted to do. But to us, the way to do that is not having a gigantic pile of money in the bank. Now, I'm not going to turn down $1 billion in case anyone wants to give it to me. But a much more attainable goal is for me to get, say, $10,000 a month in passive income or $20,000 a month in passive income. Now, that's much more attainable to me than piling up $10 million in the bank. So what I really want is a collection of assets which pay me a comfortable amount of money every month. That will afford me the ability to buy whatever I want and do whatever I want and the free time that I want. And I don't actually need a gigantic pile of cash. And that's a goal that I know that I can achieve as opposed to this gigantic number with a bunch of zeros. So that's why we've run across the Rule of 72, but it's not particularly relevant in our investing lives. Anyway, back to the main point. All of the previous discussions have been about estimation. And if you want a more precise answer, the math can be very lengthy.
All right, so don't freak out. Right, these are our financial calculators. They're, yes, doing all of this complicated math is why financial calculators were invented. There's a lot of good ones out there. You know, there's some physical ones like the ones on the left and right here. There's ones out on the web, you know, there's apps, there's tons. So just make sure you get one. We learned how to use an HP 10B2 from Gary and Clyde, you know, and you can learn from Bill Tan. He also teaches a really good class. It's a very useful tool, but just like any other tool, it's limited by the skill of the user. Okay, so you need to take some time. You need to love your calculator. You need to get to know it. So to really master it, though, you need to understand the time value of money, and that comes with 5 different aspects. We're gonna start peeling those away now. There are 5 different, but they all sort of work together. They kind of push and pull on each other, these different aspects of the time value of money, and you'll see what we mean as we start talking about each of them. Kyle.
So obviously time is going to be a crucial aspect of the time value of money. It's right there at the beginning of the name. Time can be tracked in months, quarters, years, days, whatever you want. And it can have great impact on your numbers. We generally deal with time in a monthly scale. And that's mainly because we deal with mortgages and rents. And when you pay on a mortgage, it's almost always a monthly payment. And when you receive rent, it's almost always a monthly payment. So, for example, if we have a mortgage that is a 30-year term, then I'll have 360 monthly payments. You got 30 years, 12 months a year, 360 months. So in this case, our time value would be 360. And we'll come back and use that in a specific or in a concrete example a little later on, so it'll be easier to understand. However, if you're dealing with annual payments and you still want a 30-year term, then you only have 30 payments because you only have one payment per year, 30 years. You have 30 payments. And we aren't going to touch too much on that, but we wanted to put the idea in your heads because we've seen it be a common problem for many people to just automatically multiply by 12. Okay, sorry. I can hear myself just fine. A lot of people will get the wrong answer because they're trying to figure out a monthly payment situation, but their calculator is set to be in annual mode, something like that. We get those emails a lot. But you don't need to worry about this tonight. We'll make sure that everything is correct. In calculator speak, time is referred to as N, or number of payments, or number of periods. The image at the bottom here shows the buttons on the top of the calculator, which represent each of the 5 aspects of TVM. We've circled them in blue here. Does this make sense, everybody? Don't freak out. Remember rule number 1. There's only one rule, and it's don't freak out. Okay, so the next aspect is interest rate. However, we use different terms to describe it when we're paying it versus when we're getting paid. So when we're paying on a loan, we talk about the interest rate we're paying. If we're receiving money, then we talk about ROI, return on investment, or yield. When we discuss interest rates and ROI, we commonly speak on a yearly basis. When someone says a loan is at 6%, they mean 6% per year unless they state otherwise. But you always need to check just in case because it does change things. In calculator speak, interest rate or yield or ROI is referred to as I/YR, which means interest rate per year or interest per year. Does this make sense? Okay. So we have time, we have interest rate, and now we need the values of money. Now there are 3 different types of money value that we use in financial calculations, and they have to do with the different periods of time. So how much money is involved now, how much money is involved in the future, and how much is involved every month, quarter, year, in between. Now these numbers are positive and negative based upon which direction money is flowing. If you receive money, the account is positive. If you pay it out, then it's negative. So remember, receive is positive, pay is negative.
All right, so the amount of money now that we were talking about is, how much you're going to be paying or receiving in the present day. If you are you borrowing money for a mortgage, that's your now, okay? That's your now value. It happens today and just one time. In calculator speak, this is PV or present value, all right? Now, the amount of money in the future, this is how much, for example, your balloon payment is going to be, or how much you're going to have after your retirement account matures. Okay, it's something that's going to happen at some point off in the future, just one time. Right? It could be 6 months from now, it could be 50 years from now, but it's off in the future and it happens just once. The amount of time, the amount of time between now and future is dictated by n, by the time. Okay, if you got 360 monthly payments, then there's 30 years between now and future. All right, and each of these money values can be 0. For example, if you've got a mortgage and it's a fully amortizing loan, right, at the end you don't owe anything, right? So you owe $0 at the end of this loan. So your future value at the end of a fully amortizing mortgage is going to be 0. Now, in calculator speak, this is FV, or future value. All right, does that make sense? No one's freaking out? Okay, now in between the present and future, we have the payments. For this, they need to be the regular payments. They have to be the same amount every month or every year. They can't change when we're doing these calculations. Your mortgage payment is the same month to month. That's the kind of thing. There are ways to do uneven payments, but we're not going to be talking about that tonight. If you have some deep questions, come talk to us afterwards. Now, payment, just like the other ones, can be 0. An example of where it might be 0 is if you are purchasing stock that doesn't have any dividends. Okay, you're gonna spend some money now in the present, present value, and then off in the future you're going to sell that stock. That's the future value, but in between you're not getting any money back, so your payment will just be 0. Okay. In calculator speak, this is PMT. Now, remember, when you're dealing with these money values, you have to watch your positives versus your negatives. Okay, if it's money you're receiving, it's positive. If it's money you're paying, it's a negative.
So, as you can see with the 5 different aspects of the time value of money, you could see that it might be possible that someone might make a mistake at least once. Now, a way to help prevent us from making mistakes is to use pictures. We like this type of picture. It's called a cash flow diagram. Since we're dealing with something that happens over time, we use a timeline to draw a picture of it and better understand the situation. So the timeline starts on the left at now and moves into the future the farther we go to the right. So we're going to talk about money coming in and money going out. And to keep things simple, we're going to imagine that that's a down arrow. Keep things simple, we're just going to refer to money going into your wallet and money going out of your wallet. So as we mentioned before, when you receive money, that's a positive number. And when you pay money, that's a negative number. In our pictures, when we receive money, we're going to draw an arrow up. And when we, because we have gotten money into our wallets, the amount of money in our wallet has gone up. And when we pay money, we're going to draw an arrow that points down. And that's because the amount of money in our wallet just went down because we took some out to pay it out. Does that make sense to everybody? All right.
Sorry about that. Keynote translated from desktop to iOS and apparently did not like my arrows. So, all right, on the next few slides, we're going to be talking about, we're going to have a lot of numbers, okay? But the important thing on these slides are the concepts. You don't really have to worry about the specific numbers. You don't need to worry about writing them down, okay? We're just talking about the concepts here, how the time value of money applies to different situations, and what those common situations like when we put them on a cash flow diagram.
You may have said it, and so I just want to ask you to clarify.
Mm-hmm.
The point of the financial calculator is to solve any problem, right?
So the question was, is the point of the financial calculator to get to solve a problem, solve one of these time value of money questions? Yes. So when we want to find out something about an investment, how much it's worth, what kind of return we're getting, yes, you use the financial calculator to calculate those. And
So then, and I know I talked a bit about this, but if you can clarify, when there's 5 spots, you need to have 4 answers to be able to get the 5th one.
absolutely, and we'll hit that in just a minute.
You will be.
Don't worry, we got you covered.
We'll got you covered. Sorry, we have to wind up to it just to make sure we don't leave anybody behind. All right, so we'll take a simple example of buying some stock. So Facebook just IPO'd, so it sounds like a great time to buy, right? So we're going to buy 1,000 shares. We're going to be rich, going to be a billionaire. So we're going to buy 1,000 shares of Facebook. We bought it at the IPO at $38 a share. Okay, we figure it's going to take off. We're going to make a fortune. It's going to be great. So we put now, when we bought that, over on the left-hand side at present value. So, and we paid the money, so it's negative. The arrow goes down. Now, at some point in the future, we're going to sell that stock. And when you sell the stock, you get money. So we're going to be receiving money at some point in the future, so the arrow goes up. So we managed to then sell it later that day sell it today, for $33 a share. We're not very good at stock investing, but at least our broker made money. So does this make sense that this is, what a stock purchase would look like? We spent some money over here, and then in the future we made some money. Does that make sense?
Okay, so let's talk about another common scenario, and one that we real estate investors deal with more than stock investing if we're lucky. That's mortgages. So when we take out a loan, we receive a bunch of money. And yes, you don't generally get to put it into your wallet. It goes into escrow on your behalf and then gets sent off to somebody else. But it is yours for the interim. So because that money is, and then when you make payments for a certain amount of time, and at the end the loan is entirely paid off, and we call that a fully amortizing loan. So let's break it down. The amount of money we have today is going up because some lender is giving us a whole bunch of money today. So we need to start with an up arrow today on the left side. Now we're going to be making payments every month, so the amount of money we have each month is going down. So we need a bunch of down arrows. Now, we aren't going to draw 360 down arrows on our cash flow diagram, but understand that this represents 360 down arrows. Now, at the end of the loan, we don't owe anything else, so we're going to put a 0 at the end of the timeline in the FV slot all the way on the right. Now we've got everything about our loan in our diagram except for the interest rate. So we're going to go ahead and toss that in this little box right here. So does that make sense? We have it all drawn out here on our diagram. We make sure that we get all our arrows in the correct directions. If we happen to put all up arrows, we would immediately see, wait a second, that doesn't look right. So that helps us to catch any errors that might have. So what if our mortgage is not fully amortizing? Well, that means that we owe money at the end. And so we have to pay out a big chunk at the end. So what would that look like? So we previously had this diagram, but the 0 at the end here isn't right because we have to pay a balloon. Now, since we're paying this money at the end, the amount of money in our wallet is going down, and so the arrow needs to be a down arrow, and it should be in the FV slot all the way at the end of the timeline.
All right, so your calculator can calculate all these different aspects of the time value of money. It can calculate time, how long a payment stream is going to last. It can calculate what an investment is worth. If you're trying to discount a note, you can use it for all of these different things. All right, the calculator is smart. Sorry. It's smart. It can do the complicated math for you. You just need to put the right numbers in and then it will, it can tell you your ROI. Just you have to make sure to put the right numbers in. So let's take a look at a few real examples. We're going to continue to talk about some numbers here. Don't freak out. It's all good. Just take a deep breath. Pardon me. One of the other ways that we avoid making mistakes is, in addition to the cash flow diagram, is we use what we like to call a Gary box. So Gary Johnston uses these when he's teaching his class, and we find them incredibly useful. So you can just lay out each of your numbers and figure out what they are. One of the most common mistakes when you're dealing with your calculator and you're putting your numbers in is using positive versus negative numbers. So be very careful of that. Like if you're doing a mortgage payment, right, your payment's going to be negative. Just keep these things in mind. So let's use an example. Someone's going to lend us $150,000. And we get a PV arrow that goes up. We're going to be paying for 30 years, 360 months. Each of those payments is going to be $900. We're adding to this, and we're filling in our Gary box. It helps us. It matches up with the calculator, so it will help you too. It's fully amortizing, so we've got 0, and our interest rate is going to be 6%. All right, now we did this not left to right, just because we wanted to connect the idea to how we've been discussing it in the time. But Gary and Clyde and Bill, they will train you to enter your numbers from left to right. First N, then IYR, then PV, then PMT, and listen to them. That is the way that you should do it. Absolutely. It's the way that we do it as well. Just don't, it helps you not forget anything, okay? Now, back up one slide. So, like Angel was asking about, when it comes to your calculator, out of these 5 values, you need 4 of them. And then the calculator can tell you what the 5th one is. So in this case, if we knew that our loan was 30 years, back up. If we knew our loan was 30 years and we were borrowing $150,000 and we were going to be paying $900 a month, we could put these numbers into the calculator and ask it to tell us what the IYR is, to tell us what the interest rate is, and it will tell us 6%. Okay, so as long as you have the 4, you can find the 5th.
So now we're going to go through an example of each of these, of calculating each one of these, just so you have an idea as to when that would be useful, how you would set it up, and how you would actually do it. So calculating ROI, or interest rate per year, is one of the things that investors like to do most when evaluating deals. Let's say Bob the borrower has borrowed some money from Kenny, and he used it to buy a house. So Bob is making monthly mortgage payments to Kenny. So Kenny holds the note. At some point, Kenny needs $15,000 for whatever reason. So I offer to pay Kenny $15,000 today, and in exchange, he's going to give me 36 of those monthly mortgage payments. So the money that Bob is paying goes to me instead of to Kenny for those 36 months. So we know that each payment is $500. The payment stream will cost me $15,000 today. So I want to find out what return do I get on my $15,000. So we put all of these numbers, all 4 of them, into our calculator. We put in N, we put in PV, PMT, and FV. And then we tell the calculator to calculate IYR for us. Now, we know time, the value is now. So the payments, let me start that over. So we know that we're paying out this money for these payments, and at the end, in the FV slot, there's nothing left. So we aren't owed anything more. So we have all 4 of these, and because we know 4, we can find the 5th. And when we find the 5th, we find that it's 12.25%. So you get a 12.25% IYR, or ROI. That sure beats what the bank gave me this month. Anybody?
So we may be repeating ourselves a couple times tonight. It's because some of these concepts are a little hard to do, so we want to hit them a couple times. Now, another thing that people will commonly use a financial calculator for is calculating a mortgage payment, right? You know how much you want to borrow. You know what the person, what the lender is going to charge you, and you know how long the loan's going to be. So you want to figure out what your payment is. You can put each of these values in 360 months, 4.25%, 200,000. It's fully amortizing, and then you can calculate your payment. So once you have the 4, you can do the 5th, right? Does this make sense? Does this fall into anything? Don't fall asleep on me. Don't freak out.
So why would I want to calculate time? When would that be useful? Well, let's say that you've been paying on your mortgage for 6 years or so, and you currently owe $375,000 on your house. Your interest rate is 4.75%, and you make monthly payments of $2,217. Now you get a raise and you decide to start paying more than your normal mortgage payment each month so you can pay off your mortgage early. So you're going to pay $3,500 a month instead of your $2,217 normal payment. So the question is, how many months do you have to make that $3,500 payment until the mortgage is completely paid off? So you put in all 4 of the values that you know, and then you have the calculator determine the 5th one for you. It'll take you 180 months, a little less than 11 years to pay off the loan. And that cuts it. What? What did I say? All right. It'll take 140 as opposed to the 280. That's where the 80 came from. So you're cutting your time in half from 280 to 140. So this is an example where we were talking about before, where we use each of these values they kind of push and pull on each other. So when you change one of them, the others will change in response. We increased our payment, and that caused the time to decrease. You know, when you get a financial calculator, you can actually spend some time trying to gain an intuition about how this push and pull between the numbers works. You could say, well, what if I raise it to $4,000? What would that be? How about $5,000? How about $2,300? And if you do enough of these, then you kind of get an idea as to changing which variables to what degree changes which other variables. I find it an interesting exercise, but as we've covered, I'm a nerd.
He really is a nerd. Okay, so we'll hit a couple more examples on why you would want to do each of these things. So finding PV, this is most common when you're trying to discount a note. And a lot of us are interested in notes. Yes, absolutely. We're going to be explaining what discounting a note means right now. So let's say you've run across a note for sale. There's 39 payments left on this note. You want to get a 20% return on your money. All right, and the payments are $750 every month, and then at the end there's a $5,000 balloon. So if I'm going to buy these payments and I want to get a 20% return on my money, what would I be willing to pay now? So I'm going to be willing to pay about $24,000. That is a good question. So the question was, what is the original amount, the current principal balance? I'm glad you asked, because that's what I was about to ask you. When we look up here, what do you guys think the principal balance is? Anyone? We can't tell. We want to get 20% on our money, and so we're willing to pay $24,000 for this note. But nothing up here actually tells you how much is left, how much principal balance is left on this note. It's the amount we're willing to pay really is unrelated to what the current principal balance is. If the original loan is at 4%, which is a lot lower than the 20% we want to get, then we would expect the principal balance to be a lot higher. One of those basic ways to increase your ROI is to reduce your investment. So I want to pay less for it to increase my yield.
So another important thing about is about the interest rate on the note. So we'll go ahead and take another look at the note we're going to purchase. So as we mentioned, it did not include the current principal balance, but it also didn't include the interest rate on the loan. Now we know N, we know PMT, we know FV, and so if we knew the interest rate that the borrower is paying on the loan, we could determine how much is currently left on the loan. So I'm going to tell you that the interest rate on the loan is 5.5%. So Bob, the borrower, has been paying 5.5% on this note, and he now owes about $31,000. So another way of saying this is, if we want to get a 5.5% return on our investment, and coincidentally the amount of interest that Bob is paying on the note is also 5.5%, then we're okay paying exactly what he owes for it, because that's the current principal balance, and it's at the same rate. So as the money happens over time at the same rate, its present value is the same. So it's important to understand the difference between the stated interest rate and the percent return that we want to get when we buy it at a discount. So when we buy this note for $24,000 and we get a 20% return, what interest rate is Bob going to be paying after that? Anybody?
We wanted to bring this up because Bob's terms don't change, right? He signed a note to borrow a certain amount of money and pay 5.5%. His payment is not going to change. The interest rate that he's going to pay, it does not change, right? The terms do not change. We're buying this at a discount, right? It's on sale, and the return, we're trying to increase our ROI from this 5.5 up to 20%. And so to do that, we have to decrease our investment. We're going to be paying less. We're going to be buying it at a discount. It's on sale. And that's what we mean by discounting a note. So the important thing we just wanted to note about this example is that the stated interest that's on the note that you're buying is unrelated to what your yield is, what your ROI is. That's based on how much you pay for it.
So just one other thing we'd like to mention before we move on, and trust me, we will move on soon. If Bob decides to pay off the note next month, right after I buy it, then he'll pay the full principal balance, which is about $31,000, and we just paid $24,000 for the note. So that's pretty nice. So we just made a quick $7,000. This is the kind of note that reminds us of what Ellis and Gerald like to call happy, happy, happy notes. So we're happy if Bob keeps paying because we're getting a 20% ROI. It's tough to beat. We're happy if Bob pays it off because 7,000 extra bucks in the pocket, that doesn't suck. And we're happy if he doesn't pay and we have to foreclose because we make sure that we always buy notes that are protected adequately with collateral. So that's one of the nice things about note investing. This makes sense to everybody? I know we covered a lot in this note thing. Yeah? Everybody good? Yes?
Are you factoring in inflation into
inflation. This is, no, sorry, let me restate the question. Are we factoring in inflation in our ROI value? The answer is no. Mathematically, you can just subtract your inflation value from your ROI and you'll get approximately what your real after inflation value is. We're actually going to be talking about value inflation at some length a little later on. So if you're still unclear on how inflation works when we get done with that, would it be okay to raise your hand then? Can I put you off? Okay, good. Okay, so let's move on from IYR and note investing. We'll talk about future value now. So why would you want to know future value? Well, we want to figure out how big a balloon is going to be or how much you're going to owe on a mortgage when you want to sell a property at some point in the future, or you want to know how much your IRA is going to be worth at some point when you want to retire. So let's say that you expect to retire in 18 years, which is 216 months. So we put that in the end slot. Your stockbroker tells you that you can expect your account to grow at 11% per year, and he does this with a straight face. Your account currently has $100,000 in it, and you expect to deposit $500 every single month into that IRA until you retire in 18 years. So how much does your stockbroker well, he can't promise you. How much does he earnestly suggest to you that your IRA will be worth when you retire with that 11% return? Well, he expects your account to have a little over $1 million in it. That sounds pretty good, right? Now, what if his predictions don't come true? If the stock market yields only 4% per year, how much will your IRA be worth then? At that point, rather than having $1 million, you'll have about $363,000. So that's less good. We're going to be charitable here and say he's going to comp this one. Yeah, the question was, what about his charges and the taxes? Yeah, that just makes it worse. So hopefully this underscores the criticality of getting a high return on your savings and the length of time you get that high return. The higher your return and the farther time you can get that return, the more money you can hope to have in the future. And this is especially critical when you're talking about retirement, because Fancy Feast is not a good dinner. So we know the time value of money comes into play when we borrow or lend money, but it also affects everyone all the time through something everyone has heard of, which is called inflation.
Inflation is everybody's favorite time value of money, right? Okay, so, excuse me, page went the wrong way. All right, so over the last 30 years or so, we've had an average inflation of about 3%, okay? But it's 3% compounding, and that's really important to remember. So, if you have something that cost you $100 this year and you have 3% inflation, it's going to be $103 next year. But the year after that, it's not going to be 106. It's actually going to be 106.09 cents, because that year's 3% is already built on top of this year's 3%. So the compounding nature of the time value of money, and as we can see it, inflation, that's what adds up to some serious loss of buying power, okay? In fact, it's so powerful that over 30 years of 3%, something that cost you $100 in 1982 costs you $238, right? This isn't just multiplying by 3% a couple of times. This is some serious compounding. It's not to be messed with. So inflation can be a huge threat to money that you've stowed away in the mattress. Another of my favorite quotes from Gary is that interest is always working, either for you or against you. Okay? Inflation works the same way as interest, and it's working against you. Yes, well, so let's say that inflation goes back to 1980s levels, about 5.5% for the next 15 years. Does that seem reasonable? We've had low inflation, but they've been printing money. So who thinks we're going to have some bigger inflation, right? Now this 5.5 is really not an extreme rate. We had it in the 80s, we had it in the 40s, we had much bigger in the 70s and 100 years ago. So let's take a look at how inflation will affect us. So let's say we inherited $1 million from a rich uncle. Okay, we decided to be dutiful and try and make sure that money grows, and so we put it into a bond for 15 years that grows at 2.5%. So we put that $1 million in, we invested it, so we paid it out, $1 million now, and it grows up to be $1.45 million, right? So the account grew by almost 45%. That sounds pretty good, right? All right. The problem, though, is if we have 5.5% inflation, that 1.45 million, often 15 years from now, in today's dollars, it's only got the buying power of $648,000. All right, so somehow we invested our money, we tried to be responsible, and we lost money somehow. It's because inflation chewed it up.
So in deflation, essentially exactly the opposite happens. Inflation and deflation are essentially the same thing. They just have the opposite sign. So deflation is negative inflation. If you had a deflationary period and you just stuck that money in your mattress, over time it would actually increase in buying power. I would be a little surprised if we had deflation soon. The Fed is certainly trying to stop us from that from happening because of what they've seen in other countries where it has happened, and that's been extremely bad. So I have power in our Fed overlords, or I have faith in the power of our Fed overlords. Anyway, so let's go on to inflation. We've said is the giant boogeyman. It's what destroys value. It's what works against us all the time. But I'm here to tell you that it doesn't have to, and it doesn't always. We can actually use inflation to our advantage. So let's keep with the same scenario. We've got 15-year time frame. We have a 5.5% inflation, and we have $1 million that we just inherited from our rich uncle. However, instead of putting that into a bond fund, we're going to buy houses with it. So what we're going to do is we're going to finance these houses. We're going to put 25% down. So we're going to take this $1 million and we're going to borrow another $3 million. We're going to put these into $4 million worth of real estate. Now, we have $4 million worth of real estate and we have $3 million of debt on top of that. So that means that our net worth remains at the $1 million that we just inherited. That all makes sense. Now, our debt service every month is going to be $18,962 because we're going to borrow this $3 million at 6.5% interest fixed. So we can get rent after expenses, and that's going to be $18,900. So if you do the math real quick, you'll see that every month we're actually losing $62. And that isn't an ideal situation, but it's something that we can probably handle for a limited period of time, and particularly because we're planning on increasing rent as time passes. And even a very minor rent increase will take that $62 and make it flat, or will give us a profit. So we aren't showing you a situation that's some kind of fantastic killer deal. You're paying fairly high rates to borrow that money, at least by today's standards, and the properties are about a 6 cap. So they're not fantastic properties that you're getting at a gigantic discount or anything like that. And you're also negatively cash flowing for the first year. So we just want to show you that even in a non-ideal starting situation, if we have inflation and you use it well, you can actually use that to your advantage. Now, we want to caution you not to buy negatively cash flowing properties, so don't do that. This is just an example. And again, inflation in this scenario is going to be the same 5.5% that we assumed before. So rent and rental expenses are going to rise at this 5.5%. So the rent after expenses figure also rises at this 5.5%. Your houses, we're going to say, appreciate at this rate. Now, it isn't necessarily directly correlated, but especially during bubbles and such, but the Case-Shiller index adjusted for inflation shows that the normal rise in housing prices has been growing slightly faster than inflation over the past 40 years. It was a 40-year chart we looked at, right? All right, so we'll keep it simple and say that housing prices will just rise at the same rate as inflation rather than exceeding it, as it has done. So after 15 years, the total of our monthly house payments is still $18,962 because we got fixed rate financing, and this is really going to benefit us. So after 15 years, your rent after expenses is going to grow from $18,900 to $42,193. So after 15 years, rather than losing $62 a month, you're going to be gaining $23,231 per month. Yeah, so that $1 million today turns into nearly $279,000 per year in rental income after 15 years. Now, after 15 years, and we're going to skip that slide for now. After 15 years, you'll still owe $2.2 million for the houses. And after 15 years, your houses will be worth almost $9 million. So after that same 15 years, your net worth due to the houses is now $6.7 million as opposed to the $1 million you started out with. But with such high inflation, the buying power of all of that money is less than it is today. That's true, and so we account for that. So in today's dollars, the income from the houses is a measly $10,400 per month. So in today's dollars, your net worth due to those houses is merely $3 million, so triple what it is today. And all you had to do was own those houses and manage them so they make you wealthy and put good money in your pocket every month. But the real key to this is that inflation can help you if you are on the correct side of your debt. You just have to make sure that your debt is at low and fixed rates. Does that make sense to everybody? Okay.
Before we move on from inflation, are there any questions? Okay, if not, we'll take some more questions later on. Okay, we'll take some more questions later on as well. All right, so, sorry. Inflation is something that's happening on an economy-wide scale, but we want to use its cousin, interest, to benefit us directly. Real estate notes are just one of the greatest ways to do that. There's nothing magical about them, right? It's just a promise to pay. A lot of people think that you have to have a bank involved whenever you buy a piece of property. Angel will tell you that that's absolutely not true. If you understand the time value of money and you understand how to use your financial calculator, you can make these notes work for you, okay? There's a lot of money out there that's not in the hands of bankers, and the abysmal performance of the stock market and savings accounts, it makes it relatively easy for us to convince the people who have that money that they should start thinking of other investments. If you can get them thinking outside the bank, you can have access to all that money. All right, we are surrounded by people that are constantly having their value, their money nibbled away by inflation, right? They're getting essentially 0% in a savings account or 1% in a CD, a glorious 2.9% for a T-bill, right? It's just notes that are secured by real estate can be an excellent product for you to offer investors, because you can offer them good, stable returns that are protected by equity, and that's just not something that a stockbroker can offer. So let's say that you're talking to someone and they do want a better return, a stable return that they're not getting in the stock market. So you can ask them, if inflation is devaluing your money at 3% per year, which it's been doing for the last 30 years, and you bought a T-bill that's increasing its value by 2.9%, are you going to be better off or worse off, right? Clearly, you're going to be worse. The inflation is destroying your money faster than you are growing it. All right, so the essential idea is that you must at least match inflation when you're growing your money. Otherwise, you're losing money. You got to keep up with it. If you have a coworker who's got $100,000 in the bank, and you'd really be surprised how many people there are who do that. They have just a ton of money in the bank that they're sitting there, they're worried about using it. And they're getting 0.1% in a savings account. If you could borrow that money from them for a real estate investment and you protect it thoroughly with equity and you give them a 5% yield, aren't they going to be a lot better off, right? The rate at which you borrow money from private lenders, it may be better or worse than you can do with a bank if you go get traditional financing from a bank. But when you borrow it from a private party, flexibility can more than make up for a higher interest rate. You might be willing to pay, I certainly would be willing to pay a higher rate than the banks are paying to deal with a private party, because I can modify the terms. Anything that we agree on, we can do. That's, and if they, if things change for them and they need some of that cash back, they can sell that note, right? They can sell part of it. Maybe they only need a small bit of money, so they can sell part of that note. The payments will go to somebody else, and then they get the note back when it's done. You can, anything you can put together. If they want in on the deal, they don't want to just get the interest, they want some equity sharing, you can do that. It's just whatever you can agree on.
Now, a lot of people have a lot of money in their 401ks, their retirement accounts. And this presents a big problem for people who are depending on their retirement accounts to be able to retire in comfort. So fear, uncertainty, and doubt dominate the emotions of these people because they think they need these accounts to retire. And in many cases, that's true. They also think their only options for investing their retirement money are in stocks and bonds because that's all their companies offer to them. And that's all anybody ever talks about on the radio and on TV. Many people are very disconnected from their accounts. They have no idea how well it's doing or how often, and they often have a very skewed perspective on on its performance. The news they receive is inconsistent and sporadic. Most of the time it's alarmist. For example, if you looked at the S&P 500, which is generally considered to be a good bellwether of the entire stock market, and you did that in the beginning of April, you would have seen that the first 3 months of 2012, the S&P 500 went up by 12%. That's in 3 months. That's fantastic. Man, I want all my money in there. The problem is with that is that as of today, that 12% increase is only a 5% increase. So, okay. Now, let's look at more recent history, and we'll see that over the past year, that 12% gain, actually that's a negative 1% gain. And then if we look a little bit farther back, then over the past 3 years, we're at a 48% increase. And over the past 5 years, we're at a 13% decrease. So what we're seeing here is a gigantic level of volatility. If you're looking at this and thinking, I can plan for my retirement in 20 years, I want whatever you're smoking. This level of volatility can devastate your plans for the future, including keeping you working when you're ready to retire. So in fact, in the third quarter of 2011, the value of all retirement accounts in the United States dropped by $1.4 trillion. Now, a trillion is a million millions, all right? So $1.4 trillion evaporated out of people's retirement accounts. These people were planning on using that money to retire. What are they going to do now? This guy, he's not happy.
All right, so this is where we as investors can come in. All right, you can borrow this money. All right, retirement accounts can be self-directed. A couple of people already talked about it when they were introducing themselves. And that that IRA money that can be lent to real estate investors. Okay, you can give these people, these lenders, a good return over a long period of time. You can offer them safety, stability, and they simply can't get that on the stock market. Okay, this cash flow diagram shows the S&P over 5 years. So if we bought 5 years ago, we bought into the S&P index, and we invested $152,000. That means 5 years later, we now have $131,000.
That's before inflation.
Yeah, and that's before inflation and taxes, right? So that's not good for your retirement. Now, on the other hand, if we convince this person to lend the money to us, and we gave them a 6% interest, amortized over 30 years, but with a balloon in 5, so we can match it up here. Like we'd pay them 60 payments of $912. And after the 5 years, they'd get $141,000 back. So even if we ignore the payments, they're getting more money back in the end. But if we add the payments in, they got $196,000, right? Especially when this real estate investment is secured by equity, don't you think that's going to be a better return? Don't you think that they're going to like that a lot better? It seems like a better option. Now, since it is possible to self-direct your IRA, right? They can lend this money. You can help them improve and stabilize, so it's not this volatile thing. You can improve their portfolio. After you explain that they can do this, it's going to be up to you to convince them, to prove to them that what you're offering is superior to them than to what they're currently doing. And to do that, you're going to need to understand the time value of money. To be able to make this argument to them, you're going to need to know how to use your financial calculator. You're going to need to understand how to perform these calculations, right? But this is a win-win, right? It's cliche, but the person with the IRA is getting a better deal. Their retirement is going to be protected. It's going to be better. And you're going to be able to run your real estate business even better because you have access to this very flexible source of private money. Another thing that's important to remember, though, is that you are dealing with their retirement. Okay, you may be, you're going to be securing their investment with equity. You're going to be making sure that they're protected by making the payment be easily supported by the property. Okay, you're going to add them to your insurance policy. You're going to do all these things to protect them. But when it comes down to it, the most important thing that you can do to protect them is you. You have to protect them. All right, it's part of our conviction that if we convince somebody to invest their money with us in this fashion, that we will lose money before they do. Okay, we're going to make them whole no matter what. All right, they're relying on you for their retirement, so do not let them down.
Also, remember to seek professional advice when attempting this. There are a lot of rules and regulations, laws that are involved with how you do this. There are specific ways to do it. It's all completely above board. And there are several high-quality, reputable companies which specialize in just this sort of transaction. So seek them out. Kenny and I have some experience with both UDirect and Entrust, and we've found them to be good. There are other good ones out there, we're sure. Those are just the ones we have experience with. Any questions before we move on to our last topic? So the question is, what is the marketplace for note purchasing? And the short answer to that is for people who aren't in, like you and me, what we do is we go and see brokers like Gerald. So Gerald's the guy in the pink shirt right there. Talk to him afterward in the networking session. Or the guy sitting next to you. I'm sorry, I completely forgot. I'm sorry? Barry, yes. Barry, the guy sitting next to you. So there are people who have connections with banks who have foreclosed notes or even performing notes. Those people can act as brokers and sell them to you.
So does a Charles Schwab or E-Trade negotiate a note?
Does Charles Schwab or E-Trade negotiate notes? And as far as I know, the answer to that question is no. I've never heard of them doing that. If you find out that that's not true, let me know. Although I suspect that Barry and Gerald will give you much more competitive terms than those guys will. Yeah. Any other questions? Okay, on to our very last topic. Let's talk about balloons. So, Yes, balloons. So first of all, let's say that let's say that we agree with Bill Tan here that balloons are for clowns. Specifically, when you're putting together a borrowing situation, what you want to do is have long-term, fully amortizing debt. So when you're creating notes, you want to avoid building balloons into them. However, I personally wouldn't pass up on a good deal just because it has a balloon, because I think that there are enough options in the future that if the balloon were coming due, I could probably figure out something to do with that. So remember, if we're talking about money that's far off in the future, especially if there's a high interest rate or ROI involved, the value of that money in today's terms can be very small. So the further off in the future, and the less it's worth today, and the higher interest rate or yield, the less it's worth today. So let's say you have an opportunity to bid on a note. So Gerald or Barry has this note available. It's a 360-month mortgage, and you want to get 15% on your money. The payment is $12.64 a month. So you tap these in, and you figure out that you're willing to pay $100,000 for this note. So if the note had a $10,000 balloon, how would this change your bid? So how much more are you willing to pay for that additional $10,000 at the end? Guesses? Anybody? So you got this note, you're willing to pay $100,000 for it. They're going to give you an extra $10,000 as a balloon at the end. So how much more are you going to pay? Yes. Yeah, the answer is correct, and that is you would pay an extra amount equal to the present value of that $10,000 today at your interest rate, and that's correct. Anybody want to guess how many dollars and cents that would be? Not much. That's also correct. So the answer to the question is $114.23 for $10,000. Seriously. So why is that? The short answer is time. Remember that money way off in the future is not very valuable to you today. This is particularly true with a high yield or interest rate because the value reduction happens each year that passes, and that's proportional to the rate that you're getting. So way off in the future, as you back that value down, you get minus 15%, minus 15%, minus 15%, times 30, and you end up your $10,000 with $114. So a high rate means a large reduction to value over time.
All right, so we know that money way off in the future is really not that valuable. How do we use that to our benefit? So let's say Bob the borrower, we buy this note, and Bob the borrower, who's the guy paying on it, he comes to us and he wants a loan modification. And the holy grail of loan modifications is principal reduction, right? So if Bob says, hey, I was hoping we could do a loan mod and I hope you could reduce the principal, you could say, you know what, Bob, I appreciate that you've been paying on time. You're very diligent. There's a $10,000 balloon on this note. How about if we just wipe that away? We'll just get rid of it completely. How does that sound? Right? He's probably going to be stoked. He just made $10,000 and all he had to do was ask for it, right? But so what we got was probably a very loyal payer now, right? He feels like we did him a solid and it really only cost us $114. All right, so if you know how to use your financial calculator, if you understand the time value of money, you understand the real value of that $10,000, and you can turn that into much greater value by having a very loyal payer, right? All right, so these are the things that we can do with financial calculators. This is essentially the end of our presentation. We'd like to, anybody have any questions?